All right, thanks, Mike, and happy President's Day, everybody. It's always a holiday that's probably underappreciated, and it shouldn't be. So happy President's Day. Okay, I'm going to go through a couple of topics here. I cover a wide range of internet stocks, so I'll talk about technology as a whole, but I'm also going to stick with my power alley, which are the internet stocks. There's about 40 of them that my team and I cover. There's about 6 of us out of San Francisco. We do our best to stay on top of all of these stocks. I'm going to cut right to the money slide, then I'm going to come back to this later. So the biggest thing that you're probably going to get from this presentation is, what are my top recommendations? I've been giving this presentation here just about every 6 months for the last 3 to 4 years. My top picks always change because the stocks are volatile. My top picks should change. Right now, number 1 pick in large cap space is Uber. Number 2 pick is Amazon. Number 3 is Expedia. And number 4 is Google. How many people used an Uber today to get to this conference? Besides me? Okay, looks like about 32% of you, something like that. And then in the mid-cap space, I'll spend less time on this, but there's a lot of interesting assets in small, mid-cap internet land. I like Grab, Magnite, Pinterest, and Wix. And you'll see on those slides, and when I go through these later, you'll see the price target for each of these. So this is the money slide. These are my top picks right here, right now. I'll go through a few of these. But here's the backdrop on the sector. Valuation across the board is less compelling. The number 1 issue I face coming into this year is that we've had actually 2.5 years of phenomenal outperformance in the stock market. We've had 2 years in a row of 20% plus returns for the S&P 500. It's been 3 decades since we've had that. So it doesn't mean that everything reverts to the median, but it oftentimes does happen, more times actually than we realize. And there are very few dislocated stocks. If you've heard my presentation before, the way I think about stocks in the book I published, it's about hunting for DHQs. So I try to identify what I think are high quality companies, and then I wait for them to get dislocated, and that becomes my top pick. That's why right now it's Uber. I'll go through it. Anyway, across the board, I think valuation is less compelling. So we're really talking about compounders, stocks that can go up 20% because their earnings growth is 20%, not because the multiple goes higher. I think multiples across the group are largely within reasonable range, with a few exceptions. Sector fundamentals are clearly strong and I think improving when I look at retail trends, advertising trends, online travel trends, cloud computing, web presence, web building. Growth rates today are the same as they were at the beginning of 2024 or better. A year ago, we had a lot of concerns about the macro environment that as we went through the year increasingly faded. That recession that's been called for 2 to 3 years never really happened. And fundamentals, as they worked through that fear, got better, held or got better. So sector fundamentals are strong. We got 3 wild cards that I think about with tech stocks, with the market as a whole, but I'll really stick with tech stocks. Regulation, tariffs, and M&A. Regulation, hopefully, will be coming down. We'll see less regulation. We'll see pulling away of some of the regulatory constraints on some of these companies. That's a good thing. Tariffs, the extent it increases volatility for companies that I cover, the leading names have about 50% revenue exposure to international markets. So tariffs are a negative in most cases. Going to see prices rise. We'll see whether this is a negotiating tactic or we're actually going to enter into a tariff wars. Chances of it are obviously greater now than they were in the past, probably greatest than we've had in quite some time. Hopefully we won't have tariff wars, but that's a wild card for the year. And third is M&A. With this administration, we clearly have a less aggressive approach to M&A, so you're going to see more deals occur. And I think that's generally good for these assets. Maybe for some of the small caps that could get acquired by the large caps, but it gives the large cap companies one more, quiver in their arrow, or arrow in their quiver, one more option for running growth. So those are kind of the 3 broad things I think about entering the year. Valuation's less compelling, but fundamentals are just as good, if not better, than they were a year ago. I just got to think through these wild cards. Everybody knows about the Magnificent Seven. They've done phenomenally well since the middle of 2022. I focus you on the Electric 11 because that's what I focus on. So these are what I think are the highest quality internet companies. Airbnb, Google, Amazon, Booking.com, The Trade Desk, DoorDash, Uber, Shopify, Meta, Netflix, and Spotify. Doesn't mean these are all buys. I generally have a long bias towards these names, but they're not all buys. Right now, Airbnb is not a buy for me. Now, neither is Trade Desk. But these are names that I like in certain realms with certain levels of aggressiveness at these levels. And what I am struck by is just how well they've done since the middle of 2022. I don't pick the last 2 years. The market turned, and I was at one of these conferences when it started turning in the middle of 22. Not the end of 22, but in the middle of 22, because that's when the aggressive 0 to 100 rise in interest rates stopped. Interest rates didn't start going down for another year and a half, but at least we stopped going through that aggressive interest rate climb period because we were starting to work through all the inflationary impacts that we had to deal with in 2020, 21, and the beginning of 22. Anyway, we've had phenomenal outperformance in the market for the last 2.5 years. And in part because of fundamentals. The sector I look at, there are a lot of numbers on these slides. I'll just cut through it on this one. I have a sector that's got a good number of companies whose top line growth rates can be ranged between 10 and 25%. That's a premium to the market. That's why these stocks can perform well in an environment where multiples hold. Again, earnings grow 20%, multiples hold, stocks go up 20%. I also see a sector where you've had really interesting margin expansion, operating margin. There's two numbers buried at the bottom there where the average margins have gone up from 24 to 26% for this group of stocks I look at. That's great. Why have the margins gone up? 3 reasons: scale, a more disciplined approach to headcount, and I'm going to get more stock specific now. One of the reasons that Meta has done so well as a stock the last 2.5 years, 3 years, is because of what was called the year of efficiency, which turned into years of efficiency. When Meta's CEO, Meta's chairman decided that they needed to drastically reduce the headcount at the company and after that, materially slow down the rate at which headcount was going to grow. You've seen this much greater focus on dampening down headcount growth kind of across the tech sector. So that's helped margins. And the third is you've seen a lot of deployments of AI, which has also created a lot of cost synergies, cost efficiencies, and also helped taper down headcount growth. Year to date, we've gone through most of the December quarter that's been reported. Got still a few more companies, but most of the big tech names have reported. Demand trends remain relatively consistent, especially in the area where I look: advertising, travel, retail, cloud. There's some wonderful examples of what I call ROAI. You know the expression ROI, return on investment. ROAI is return on artificial intelligence. Do you have data points that show that all this spending is actually working out for the companies and for shareholders? Well, here's 2 data points that I really love pointing to. First, Amazon has talked about how the use of robotics and automation, which is just physical AI, the use of robotics and automation is allowing them to show a 25% lower cost to serve in their most advanced distribution center. What that means is that the cost it takes to ship, pick, pack, and deliver to your doorstep is 25 cents, 25% less per unit. For a company like Amazon that's doing $800 billion a year in retail sales, the largest retailer in the world now, those kind of efficiency gains are enormous, and that's just in their first distribution center. Watch as they use that technology, spread it across their other distribution centers. This is a massive efficiency gain and an earnings driver for Amazon, driven by AI. Google, here's another 25% data point. They disclosed that now 25% of their code is generated by AI. That tells you that there's a real powerful tool here that also allows you to be more moderate in terms of your headcount engineering growth going forwards. These are dramatic productivity improvements caused by AI. At the same time, we're seeing these CapEx growth rates jump up 30%, 40%, 70%. That's how much capital expenditures are growing for names like Amazon, Google, and Meta. So, and the question is it really worth it? And there's been a lot of skepticism. There's been some skepticism in the market on it. But I think those ROAI data points tell you that they're getting a good return on it. These are pretty smart, hyper-competitive capitalists. They've got a new investment area that's generating good returns. They're doing what they should do, leaning into that investment. So I think we're actually going to be in a multi-year cycle of AI investments. All right, now I'm going to go through the money slides. I'm going to go through, for the Money Show, the money slides. And I'm going to go through my top picks. And I'll give you just 1 minute on each of these, okay? Number 1 pick, Uber, DHQ, classic DHQ in my book. Dislocated high quality. Yes, it's high quality. They face 2 TAMs, trillion-dollar TAMs. That's the global delivery and global mobility market. They're now generating rising free cash flow margins. They're going to do $8 billion in free cash flow this year, $11 billion next year. So it's rising materially. They've got option value. They're generating advertising revenue, lots of synergies between their segments. They're also the market leader. You want to find companies that are facing large TAMs and are the market leader in those TAMs, and ideally still have about a single-digit % of said TAMs. I think that's Uber. So this is why it's my number 1 pick, but it's dislocated because of these robo-taxi fears. How many people took a robo-taxi to the conference today? All right, so nobody did. How many people have driven a Waymo in San Francisco? It's a very small percentage. They're coming. If you're in Atlanta and Austin, Waymos are coming to your market and in other markets too, and they're a wonderful experience. I think we're all going to be riding robo-taxis in the next 5 to 10 years. I think it's going to be a wonderful benefit. We'll also see, frankly, a decline in automobile accidents, fatalities. It's going to be a great gift to us, and it's an amazing technology innovation. But I think Uber can participate in that. I think you'll see robo-taxis on Uber's network for the single biggest reason that the ultimate demand aggregator out there is Uber. So if you own an AV fleet, autonomous vehicle fleet, you want to maximize your capacity utilization. You want to take your vehicles and put them on Uber's fleet. The costs will come down, capacity utilization will rise, there'll be positive economics all around, but I think Uber is clearly a winner. The market disagrees. That's the upside in the stock. That's the opportunity on a stock. So Uber is my number 1 pick. Classic DHQ in my book, $115 price target. Amazon's my number 2 pick in the group. Who here has ordered something on Amazon in the last 3 months? I mean, I think it's everybody. I see one person in the back that did not raise their hand. I see you. But I think pretty much everybody does. And the company has just done a phenomenal job over time of building out more selection, more convenience at very competitive prices. And the big flywheel that's rolling for them now is faster and faster delivery. Not 2 days, not next day, but increasingly same-day delivery. And the volume of this business is allowing them to bring those unit economics down. I also refer to this as the TAMiest. It faces the most TAMs, total addressable market, of all the major technology companies because it addresses retail, advertising, cloud computing. I think soon they're going to get into satellite broadband internet access. They're making a bigger push into pharmacy. Maybe they'll crack the code on groceries one day. Oh, also business to business or business supplies, industrial supplies is another market for them. So I think they face a lot of these growth efforts, growth opportunities. I think this is a phenomenally good management team. I've tracked them for 25 years. A lot of consistency, the ability to succeed in multiple different verticals tells you something special about the company. As investors, past performance tells you nothing about future performance. That's probably true for funds, but I don't think it's true when it comes to companies. Past performance is usually a very good indicator of future performance. If it's the same management team, of course they're going to make mistakes along the way, but if it's the same management team and they're successful in multiple different verticals, you're looking to stick with that name. So Amazon's our number 2 pick. 270 is the price target. Number 3 pick is Expedia. This is usually considered the weakest of the online travel agencies after Airbnb, after Booking. I like Expedia here. It's the cheapest of the 3 names. It trades at 13, 14 times earnings. Booking.com is at 20 times earnings. Airbnb is at 30 times earnings. And yet the growth rates have converged this year due to a variety of management improvements, product improvements, marketing improvements that the company has made, customer service improvements that Expedia has made. So it's a really cheap way to play a really nice, still secular growth opportunity, which is online travel. 230 is the price target. Finally, for the first time in about 2 years, I made Google a higher pick than Meta. And Meta fundamentally is looking better now. There are more overhangs on Google stock than Meta. Meta's gone 20 straight days. I think it's a record in the S&P 500. 20 straight days of rising stock prices. Great. And I'm as much of a momentum investor as anybody else. But you make more money if you're a contrarian. This is why I like Google here. There are three overhangs on the stock: DOJ, AI, and lack of cost efficiencies. And I think the chances of an antitrust agreement between the US administration and Google have increased since the election. I think Google has shown that, in fact, its market share hasn't budged at all, despite the growth in ChatGPT. And I think there's a chance here for a company under a new CFO to show a lot more discipline in a way that Meta and other companies have done. So I think there's some interesting surprises to come. I only have a $205 price target. That doesn't give you much upside from here, but I have an upside case. You put a 25 multiple on it on earnings, GAAP earnings, you get to 250. And then real quick, Grab is kind of the Uber of Southeast Asia. So this is a much more risky stock. You have a lot of exposure to markets that you may or may not understand well: Singapore, Indonesia, Malaysia, that I may not understand well. But I understand the end markets: mobility, delivery. I see the company that's the leader in that market that's just turned the corner on free cash flow and EBITDA. I saw what that did to Uber in the market about 2 years ago. You had a real nice move in Uber stock. I think the same thing can happen with Grab. And then I'll just pick one more of these small cap names because it'll probably be well known to you. Pinterest. Pinterest is a name that I think can get to $50. That's our price target. And a company that's done a lot of improvements. It's a mid-tier advertising platform, but it's got so much commercial intent on there. People don't go to Pinterest to chat with their friends. They go there to explore ideas about their own makeup, the remodeling of their house, travel ideas. Like, they go there with commercial intent, and you've got a management team in the last 2 years that's really focused on monetizing that commercial intent. They're starting to show real evidence of that. So that's one of my top mid-cap picks, Pinterest. So that's it. I just wanted to give you a couple of ideas again. If you're going to remember one or two things from this presentation, we want to stay compound constructive on the internet sector, generally on tech. I think we're seeing more signs of return on AI, ROAI. I think we're in a multi-year AI investment cycle. And one or two names I'd give you to have you to stick with walking out of this: Uber is our #1 pick, and Amazon would be our #2 pick. That's it. Thank you. And I'm happy to take any questions if you'd like.
Yes, we absolutely have time for a couple questions. Oh, man was at the microphone before I could even say anything. All yours.
Yeah, I watch every Friday morning with Stuart Varney on Fox Business.
Oh, yeah.
Why do they show that you're never invested in the companies you recommend?
I'm sorry, why do they what?
Why do they show you're not invested in the companies you recommend? That's what they put on the screen.
I'm sure I'm invested in every single one because I'm invested in index funds that would own those stocks. Directly, there's a lot of restrictions on analysts owning the stocks that they recommend. So that's why. The one odd stock that I always have to disclose is DoorDash. My son, who's now 17, when he was 14, developed his own investment portfolio. And he said, well, Dad, I want to buy a stock, for $200, what should I start with? And I said, well, what company do you know the best? Do you feel like you know the best? And he said, well, DoorDash, which caused my wife and I to immediately run to our credit card statement. And he actually picked it well. He actually also picked NVIDIA 3 years ago, so he's probably a better picker than I am. But anyway, that's why. I try to be very careful about not owning stocks that I call. I try to adjust, and I invest in them through index funds.
I have a two-part question on Google. You mentioned that Waymo might be spun out. Is that true?
I think it's a probability in the next 5 years.
Okay. The other thing is, why does the financial media keep saying that all these AI competitors are going to eat Google up when they're one of the biggest and oldest AI companies?
Well, they could. So why, could Google be? I mean, this is greater technology competition that Google's had in the search space in 15 years. There's only been one or two competitors, DuckDuckGo and Bing from Microsoft, and neither of them had any material impact on Google's market share over the last 15 years. And you had a new company come in with an innovative approach to search. I think that actually kicked Google a little bit in the butt and got Google to innovate. Things like things like generative AI overview, the results that you see when you go to Google now, I think those came like you would want us to come, from competition. Not from regulation, but from competition. So I actually think ChatGPT and OpenAI did a great service for Google investors because it really forced the management team rethink and to more quickly innovate. So I think that's the answer to your question is people focus on it because it is a legitimate new competitor we hadn't seen in a long time.
Mark, we had one question over here from this gentleman.
Any comments, software versus hardware?
Comments on software versus hardware? No, not really. I think I don't know how to be really helpful on that. I have a bias towards software since I guess in the end of the day I'm more of a software investor than anything else. But I cover usually what you get with software companies is super high margins, de minimis capital expenditures, small capex, minimal fixed investments, and that's what you get with software. That was the allure of software. But then some of the biggest software companies in the world are spending $60 billion a year on capex. So much for that theory. And then the hardware companies, I cover one of the companies that's created one of the most phenomenal wealth creation stories in history, which is Amazon, which has invested amazing amounts of money, probably cumulatively $300 to $400 billion, building out a physical distribution infrastructure, and that's done actually phenomenally well as a stock. So I don't think there's a hard and fast rule as to whether a software or hardware investment is better. Please. I won't give a recommendation on index funds. I'm sorry. It's not my knitting.
Yeah. So I've been worried about Google because of the litigation risk and the breakup risk. Do you see anything to that?
Yeah, I think there's a significant chance that Google could. I think it's unlikely that it materially would be broken up. The idea that Google would be forced to sell YouTube, I think, is highly unlikely. I think we've had a change in administration. For right or for wrong, under the Biden administration, we had a very aggressive approach to M&A. I'm not saying it's right or it's wrong. We had a generationally different approach to M&A. Well, that's shifted back now. And my guess is that this administration is going to be much more permissive or much less aggressive about enforcing M&A unless there's real evidence of consumer harm, which is oftentimes very hard to show in technology. I mean, I'm sorry, who's really been negatively impacted by Google search? Okay, maybe new competition, but wait a second. ChatGPT and OpenAI have come out of nowhere despite the dominance of Google, so I guess Google hasn't undermined competition. Please.
Any more?
Yes. Sorry, where do I go?
No problem. Right there in front of you.
Right here.
Second.
I don't cover the chip companies. I cover the customers of the chip companies, which actually may be more helpful to you. And so then the action question is, these levels of CapEx, spending on servers and chips and networking equipment that we're seeing out of Microsoft, Amazon, Google, and Meta, is it sustainable? Well, I think these companies will tell you it's sustainable if they think they're getting a good return on their AI. And I'm seeing more data points that they are. So I think is their biggest customers. And isn't it wonderful to be investing in an industry who your 4 largest customers have, on average, on their balance sheets, $60 billion in cash, and are all generating positive free cash flow? You would kill for a customer set like that. So I don't know who the chip winners are, but as a whole, as a sector, I have a bias towards chips because I know what their customers think about those companies.
Just, we'll do the last question, just as a reminder, Mark's going to be rejoining us on the stage at noon for the final panel in here. So if you don't get your question in now, I'll make sure you get a chance then.
Comments on
NVIDIA? I'll just stick with the comments I just made here. I generally have a positive view on chip sector because I cover their customers. And I don't have a particular opinion about the ones, which chip company. Sorry.
Excellent. Thank you, Mark.
Okay. Thank you.